Over the last 1 year, a lot of retail investors moved very heavily into gold, into other asset classes. But now might be the time to consider coming back to equity or coming back to fixed income.
You know, I read somewhere that 35 demat accounts have been shut. That just tells you how disinterested they've been shut. I just read it in one of the newspapers. That just tells you that how absent retail investors are.
Well, it takes an active, you need to actively go shut your demat accounts. So obviously, people right now are very disappointed. Let me bring in Dhirendra Kumar. Dhirendra, thank you so much for joining us. I want to talk to you about gold this afternoon. A lot of investors are asking was gold a safe place to put money? We're expecting volatility in our stock market over the next month or so. What would you say to those investors who are considering gold at this point?
Gold. Of course, there will be volatility in the stock market, but I think stock markets by design they are volatile, and that creates the opportunity, and that creates the danger, or that creates the psychological pressure to keep away from equity. But nevertheless it has proved to be extremely rewarding, and I think for the patient investors get rewarded by equity substantially. That apart, I would say that it is no longer true that gold is not volatile. Gold had a huge run-up, and after that, last 1.5 years, if you look at the performance, the way the gold prices have moved, and particularly the way gold prices have moved in India, for Indian investors, it has been just as volatile. So I would say if you are trying to escape volatility, you should consider only fixed income. But if you can withstand the volatility, move to equity. I don't think gold is a justifiable asset class for any long-term investor.
But Dhirendra, we can't battle it in this country. There are investors who do include gold in their long-term portfolios. Would you say we should limit it to a certain percentage of our total investable corpus? How do you advise we approach gold at all?
As I said that, most long-term investors can do without gold. And I don't think, because fixed income generates interest. The underlying asset, the underlying bonds and deposits generate, deliver interest. Equity generates, delivers capital appreciation because the underlying asset, being an owner, you are entitled for the worth of the business and its earning potential. Unlike these two assets, or even, considering real estate, you are entitled for the appreciation as well as, because houses, if they become valuable, they may not become more valuable over time always, but nevertheless you are still entitled to the rental income that a property can generate. Unlike all these assets, gold does not generate an asset, does not generate an income. It is entirely dependent on appreciation, which is dependent on more buyers or more appetite for gold in the world. So, which is quite an unusual principle on which gold operates. And what we find is that the financialization of gold has contributed heavily to the volatility of gold. It may not, and which was not the case about 5 years back. So I would say that gold as an asset class has changed its character. The complexion has changed. So most investors, have gold in a physical form, have gold for consumption, have gold for gifting it. Nothing beyond that. I think, one should not look at it as an investment, and one should carefully keep away from it.
So Dhirendra, if we are going to keep away from it, also I want to ask you very quickly, for those investors who are putting money away, maybe for a wedding in the future, or for a specific expense on gold, what is the best way to do that right now? Would you still say using an ETF is the best way to do that?
I would say that, despite all this, if you are committed to having some allocation to gold, one is that don't think in terms of percentage, think in terms of a nominal value. Then the best way to own gold in a liquid form is gold ETF. At least you are able to liquidate it as and when you need it, and it is reasonably able to track the gold prices, and you don't have to worry about preserving it or keeping guard of it.
All right, let's take a few questions from our viewers. Vivek has written in, Dhirendra, he's a young man, 23 years old. He plans to invest 2,000 rupees in a mid-cap fund for the next 20 years using SIPs. Now, he shortlisted the HDFC Mid-Cap Opportunities and the Franklin India Smaller Companies Fund, both very good performers. He wants to know if he's made the right choice. Dhirendra, for someone this young who's investing for the first time, would you recommend he uses mid-cap funds?
Yes, Vivek, you have chosen good funds. In fact, if I have to recommend few mid-cap or mid and small-cap funds, these two funds will figure there in my list as well. So go ahead. Just to remind you that these funds come with their share of volatility, but both the funds have a great quality focus, reasonable track record. Franklin India Smaller Companies Fund is not as old as HDFC Mid-Cap Opportunity, but both funds have a very high quality focus. They do all the validation, and if you can withstand the ups and downs of these funds over this time period, it should prove to be far more rewarding than the overall market, than the broad market that we have seen or that we are likely to see in the future. Besides this, there is one thing important which you have to keep an eye on. Next, 20 years is a very long period, and any market-linked investment you can't invest and forget for that long. So review your investment, the reason why they look good. If those reasons are not in place, which for example, if the fund manager who is managing it responsible for the performance, if it disappears, you really have to review your position. Besides that, if the fund changes its orientation, if the mid-cap fund turns out to be no longer a mid-cap fund, then also you have to consider. Of course, I am hopeful that the fund retains its focus.
In fact, Dhirendra, we have a question from another first-time investor. Vinay Gupta has written in, investing in mutual funds for the first time. He wants to put aside 5,000 rupees every month for a period of 3 to 5 years. So that's not as long as 20 years in the previous question. He shortlisted the SBI Magnum Emerging Business and HDFC Prudence. He wants to know if he has made the right choice. For 5 years, Dhirendra, emerging business might be a bit of a risk, wouldn't it?
Both are good funds for a variety of reasons. But they are not the right kind of fund if you are investing for the first time, and if you will be disappointed with great ups and downs. For example, HDFC Prudence, which is a balanced fund, but the equity allocation of this fund is heavily invested in mid caps, and that creates the kind of market that we have seen over the last 4 or 5 years. The first time investor or the balanced fund investor who are conservative growth investors, they have been extremely disappointed by what happened in 2008 or subsequently. Of course, it has compensated more than compensated with the returns. But the ups and downs of this fund, which because of the character of the equity portfolio, has been extremely disappointing or has been very unnerving for investors of that profile. So it may not be the most appropriate balanced fund. Likewise, and SBI Emerging Business is a very inappropriate fund if you are if you are a first-time investor. This is a fund which can be a blockbuster or could be a disaster. So once again, despite being a great, a very a decent mid and small cap fund, this is also an avoidable fund. If I have to choose, two balanced fund with conservative orientation, I would say Franklin Balanced Fund, where the equity allocation is, or even HDFC Balanced, which will prove to be far more sober or stable than HDFC Prudence.
All right, Dhirendra, many thanks for joining us this afternoon and answering our questions. If you have questions for Dhirendra, email ID is on your screen. With that, it's back to Nikunjan Aisha.